The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, China's tech sector is thriving. Stocks are at three-year highs, driven by optimism over DeepSeek, the homegrown answer to OpenAI, and strong corporate earnings. But it's still seeing declines triggered by Donald Trump's latest executive order, which serves as a stark reminder that geopolitical risk will remain an enduring force in Chinese equity markets. Despite that, is 2025 likely to be the great pivot to Chinese tech stocks? Well, to find out more, joining me now is Danish Lim, who's a senior investment analyst at Phillip Nova. Danish, welcome to the show.
Hi, thanks for having me.
Thank you so much for joining us. All right, Danish, DeepSeek's breakthrough in artificial intelligence has, boosted investor sentiment around China's stocks, with the gauge of the country's onshore as well as offshore shares soaring over 26% since its January low. Are China's tech stocks thriving at the moment? Could they be the big winners of this year?
Absolutely. Chinese tech stocks, like you mentioned, have been on quite a tear recently. The Hang Seng Tech Index, we saw it gaining as much as 6.5% in just one single day, not very long ago. Tech heavyweights as well, like Alibaba, gained as much as 14% in just one session. Other names are also hitting new milestones, such as Lenovo, Xiaomi, and all of these, I believe, shows how strong bullish momentum is. And I think, global investors are waking up to this rebound in Chinese equities. So if this trend continues, I think it's very possible that, China stocks could be among the biggest winners this year.
I see. So how are investors evaluating the recent DeepSeek's breakthrough, and how has it boosted confidence in Chinese tech stocks?
I think investors are viewing DeepSeek's breakthrough very simply as a big game changer for China's tech sector. DeepSeek was essentially able to match the performance of the latest AI models at just a fraction of the cost. And their debut of DeepSeek essentially showed the world that Chinese tech firms are very much in the race when it comes to AI, and that China isn't as far behind in the AI arms race as what the market previously thought. And I think all this also led to an improvement in sentiment as well as global investors' interest in Chinese tech stocks. And the key idea, I believe, is that if Chinese companies can develop AI technology that is able to compete or even beat Western products and do so at a lower cost, that will definitely open up a huge opportunity for growth, especially for Chinese tech stocks. And I think at the same time as well, sentiment got an extra boost because DeepSeek came at a time when Chinese tech valuations were very attractive.
I see. Well, now with an inflow into such tech stocks, does this signal that Chinese investors finally believe that President Xi Jinping's tech crackdown is over?
It does appear that way. There have been some very clear signals from top leadership in China that supports this view. There was a high-profile meeting, I think last week, between the country's biggest private sector leaders, including Jack Ma, as well as President Xi Jinping. And I think investors took that particular meeting as a signal that Beijing is ready to start loosening their stranglehold over big tech. And this kind of meeting was probably unthinkable, at least at the height of the tech crackdown back in 2020. So I think at least it does signal a shift in policy. And if you consider it from the Chinese government's perspective, the private sector will definitely provide a much needed growth engine, at least to offset their property crisis at home, as well as the threat of US tariffs. So yes, I think investors are definitely getting less wary of regulations and regulators. Instead, I believe they are now choosing to focus on companies' growth prospects and fundamentals.
I see. So what kind of opportunities do these tech stocks offer at the moment over in China? And do you see this positive momentum continuing?
Right now, I think Chinese tech stocks have a very attractive mix of value and growth. This is typically what we think as a holy grail when it comes to investing. And on the value side, many tech stocks are still at very attractive valuations that are at least low relative to global peers. So there is room for multiple expansion, while on the growth side, some of these tech stocks are at the center of many high growth areas. For example, e-commerce, fintech, gaming, cloud, and now AI. Investors are essentially, able to get a chance to buy into very fantastic growth stocks at a relatively cheap price right now. So I do see a good chance of positive momentum continuing, especially because some of the factors driving the recent rally, like you mentioned, earnings, AI, valuations, a more supportive Chinese government, all these are likely not just 1 week stories. It's more likely that they could persist over several months.
I see. But it looks like there's been this rug pull, right? This pushback for the rally to go further as we've still seen declines triggered by Donald Trump's executive orders. His tariffs on China, as it serves as a stark reminder that geopolitical risk will remain an enduring force in Chinese equity markets. How big of a hit has Trump's tariffs been on Chinese equities?
His tariffs have definitely been negative for Chinese equities, but at this juncture, they don't seem to be the insurmountable obstacle for the stock market that some may have feared prior to Trump taking office. Market reaction to tariff announcements so far have actually been pretty mild, at least based on what we feared previously, probably because there are some talks in the background of a US-China trade deal. But last Friday, Trump said he would double tariffs on Chinese products, and this led to a sell-off in the Hong Kong stock market. But I think at the same time, this was also because investors did not actually fully price in the threat of tariffs. There was somewhat of a reduced sensitivity or maybe a sense of complacency to recent tariff headlines. And there was probably also some profit-taking activity going on at the end of February. But I think last Friday, still showed that tariff risk definitely still exists. But just today, after checking in the markets, we see that the bearish momentum did not actually continue. Hong Kong and onshore stocks were little changed. The Hang Seng Tech is down maybe about 0.6%. So the fallout wasn't as bad as you might expect, mainly because there was encouraging economic data in the morning, as well as optimism ahead of the National People's Congress later this week. So I think all this suggests that there hasn't been much panic selling, and I think this is a positive sign that investors are becoming more confident in Chinese equities. And at the end of the day, some form of consolidation is pretty normal, especially such a strong rally in Chinese equities.
I see. Well, did you see a lot of investors then buying the dip during this time as they saw more opportunities in Chinese stocks?
I think we're seeing quite a bit of both behaviors, but I would say a majority are indeed buying the dip. Notably, the data shows that a lot of these dip buyers are actually mainland Chinese investors who appear to be taking advantage of the any recent price dips to start accumulating shares at a cheaper price. On the other hand, there are definitely investors who are more on the cautious side. And I would say that international investors are a bit more on the edge over here. At the same time, European markets are also doing very well. And money could have also flowed towards, the European side of the world. And I think for the remainder of this week, investors are probably going to stay on the sidelines until there's more clarity on the trade situation. But once this trade situation and the upcoming NPC clears up, we are likely to see more of these deep buyers enter the market.
I see. But none of Trump's moves should come as a surprise. We've seen it before during his first term. Is there anything different this time around, in particular to his approach to China?
Yeah, I think you're right. In some aspects, he is sticking to the same playbook in his first term, mainly, apply tariffs, pressure the other party to try to extract concessions, and then open the floor to negotiations. But I think what is different is the speed and the scope of his tariffs. Back in his first term, Trump initially imposed about 25% tariffs on just a set number of Chinese goods. But this was in mid-2018, and that was actually over a year into his first term. So the speed is very different, and this time he actually, came out swinging just from day one. His tariffs are actually on all Chinese goods, and there could potentially be higher tariffs on targeted sectors like semiconductors. Another difference, I think, is China's response. Previously, during the very first trade dispute, China actually retaliated with tariffs that are on par or close to what the US imposed. This time, China's response was a lot more restrained. I think this is actually one of the key factors that led to the market reaction not being a full-blown sell-off, but perhaps just more of a cautious pullback.
I see. Then what can investors learn from Trump's first term on China to mitigate any risks in investing in the China market?
I think there are quite a few key lessons from the first term, namely how to prepare for volatility, For example, diversifying across different asset classes and geographies. For example, diversifying into safe havens like gold. I think more importantly, or the most important lesson for investors in the first term would be not to try to time the tariff headlines and not overreact to headlines. For investors, I believe it's definitely very tempting to sell their holdings at the first sign of trouble, but I believe that can lead to your investments being very volatile. A better approach would be to rebalance your risk exposure rather than outright selling off all your holdings. For instance, if you actually sold off your Chinese holdings during the peak of the previous trade war in 2018, you would have missed out on the rebound in 2019 and 2020 when a phase one trade deal was eventually agreed on by both parties.
I see. Then what factors then could further move Chinese tech stocks to greater heights, Danish?
First and foremost, I believe would definitely be the AI, story, given that the recent rally has mainly been driven by AI optimism. And for that momentum to continue, not only continue but accelerate, I think we'll need to see some proof in the pudding from the companies themselves, especially for upcoming earnings reports from tech companies. I believe JD.com's earnings are due on Thursday. And if all these upcoming earnings reports show that tech firms are able to translate their AI advances into revenue and profit growth, that would be great news. And AI would definitely be a real game changer because it could result in new products or new revenue streams. Another factor will be policy support, especially with the upcoming National People's Congress.
I see. And finally, before we let you go here, Danish, is there anything else you'll be looking forward to in the Chinese market in the coming weeks?
Certainly, I believe I've mentioned it quite a few times. The biggest thing on my mind right now is the National People's Congress, or what we call the Lianghui Twin Sessions. It's basically China's biggest annual policy meeting, which will start, I think, on Wednesday. And if you recall, this is where the government will announce its economic targets, like the GDP growth target and policy directions for the year. And this is very important because at this point in time, the market is expecting more stimulus and more pro-growth policies in order to somewhat offset the negative impact of U.S. tariffs. And specifically, I'll be looking at whether there will be any additional support measures for tech or for AI, as well as any measures to boost domestic consumption. All these will be very important to sustain the bull market rally in Chinese equities. Looking at historical data, at least over the past 20 years, see that the real estate sector is by far the best performing sector 1 month after the NPC, alongside more policy-sensitive sectors like consumer discretionary, industrials, and material. So outside of tech, if the NPC goes well, I think there is a chance that bullish momentum could spill over or extend to some of the non-tech sectors and the old economy stocks, which so far have lagged behind tech names so far this year.
I see. Well, thank you so much, Danish, for your time and your insights today.
Thank you. Thanks, Hongbin.
Thank you. That was Danish Lim, Senior Investment Analyst at Phillip Nova. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.